Welcome to Make It Last, helping you keep your legal ducks in a row and your nest egg secure, with your host, Victor Medina, an estate planning and elder law attorney and certified financial planner.
Hey everybody, welcome back to Make It Last. Thanks so much for joining us this Saturday morning. If you're listening live, which means you got a cup of coffee because it is 7:30 in the morning now. Not everybody listens to us live, and so those of you that are listening to the podcast, I have the luxury of sleeping in, I suppose. I don't know. There's an advantage to being the first one to listen to the show, because then you can spread the rest of the information to your friends. Anyway, that's what I tell myself. We're going to be back on this show talking about an old topic that is one of my favorites. This week, we're going to talk about the fiduciary rule. There's been some updates to that. And then we're going to talk about long-term care insurance, which is a great topic to go over, because I tell you, there isn't a week that goes by that somebody doesn't ask me about whether or not they should have long-term care insurance. But before I get started with this, just wanted to thank everybody for joining us this week, especially our new listeners, and ask a favor of you. If you like this show, it would be really helpful if you went on to iTunes and left a nice review there and told other people that you liked it or shared the information, because it's one of the ways that Apple ranks these different podcasts and radio shows that are out there, as if they're reviewed well, then they think, well, maybe somebody else would like it too. And so it'd be nice to get up on the ratings and kind of start that climb to being the best radio show for keeping your legal ducks in a row and your financial nest egg secure. If I can get through the tagline anyway. All right, so before we get to long-term care insurance, I wanted to cover a little bit about the fiduciary rule. Now, I have probably spent the better part of 4 or 5 of the 15 episodes that we've done so far touching on the issue of the fiduciary rule. And so those of you that get it already are probably tired of me hitting on this topic, but there are some of you that are listening that don't understand why it's so gosh darn important to have a fiduciary helping to manage your finances. And so we're going to attack this from a couple of different ways, because in the time that I've last spoken about this rule, the fiduciary rule from the Department of Labor, which is all the way back on June 9th, so we're kind of a month and a half into it, there's been like 3 pieces of news that directly impacts this, and it's getting such little play out there. Now, I want to cover the good news first. As many of you know, I am a certified financial planner in addition to being a practicing attorney. And when I went out to start my financial services practice, it was very important for me to get what I thought was the best credential to help people with their financial planning. And so the CFP designation is something that you get when you pass an exam showing competency in 6 different areas of financial planning, investment and insurance, and they have an estate planning module. I did okay on that one. And so you pass the test and you show the experience, and you agree to some ethical rules that you're going to follow. And basically the CFP designation becomes the one that most people are looking for to make sure that they are working with somebody that's really highly qualified. Okay. So the CFP board has taken upon themselves to sort of be leading the financial services industry in what they think are best practices. And one of the proposals that is on the table for the membership is to adopt essentially a set of ethical rules that requires CFPs to be fiduciaries at all times. And I pause there because they actually create an acronym of FAAT. So I don't know if that means that they all want us to be fat. But that FAAT, the fiduciary at all times, is essentially an obligation that you, no matter what you're dealing with, whether you're talking about a qualified account, a non-qualified account, talking to them about insurance, whatever you're talking to them about, you wear the hat of a fiduciary, which is to say that you keep your client's best interests ahead of your own. And that's what a fiduciary means. Now, what I always point out is that it's staggering to me that this wasn't the case before, that financial advisors could act in their own best interest. They could sell you something that pays them more and not talk about something that might be better for you because they might not get compensated as well for it. And the Department of Labor rule that went into effect in June 9th only covers retirement assets. So it's only people that are handling retirement money are subject to the DOL rule, as I talked about in the past, that all the administration could really deal with was the retirement provisions. But this CFP requirement would then cover everything. Now, I think it's fantastic, right? I'm behind this. As a lawyer, I am always a fiduciary in someone's life. If I've taken them on as a client, I'm always looking out for the best interest. This is no big whoop to me. I'm all for it. But even if they pass the rule, it will only apply to people that have their CFP designation and voluntarily go out and get the designation and be subject to their ethical rules. And then there's a whole question about how they're going to enforce it. But at least it's a step in the right direction, because what's happened since the DOL rules really places in jeopardy the protections that consumers should be getting and what they may believe they're actually getting, since all of the news said already that they passed this rule. Because just after they passed the rule, on June 29th, the Department of Labor issued a request for information examining the final fiduciary rule, which gives them an opportunity to review whether or not they should keep it. So there's a bit of a threat on the fiduciary rule as the Department of Labor is seeking more information. In addition to that, we had a representative, and this was, let me make sure I get this right here. This is Ann Wagner from, I guess it's Missouri. Anyway, she introduced a bill that would eliminate the Labor Department's fiduciary rule and then replace it with the best interest standards for brokers giving retail investment advice. You're going to get confused and turned around in best interest for broker and retail. But the point of this is that it would give brokers the opportunity to recommend something that, in fact, may not be in the client's best interest, that the fiduciary rule would be done away with. And in the bill, in fact, there's an exemption for the sale of annuities. And I've talked a lot about annuities and where they fit and where they don't, but let me be frank, annuities are one of the most oversold and most poorly sold investments that are out there, and this bill would eliminate them from the fiduciary standard altogether, which is just terrible for consumers. Now, there is a little bit of a light at the end of the tunnel, because there are states that are trying to enact a fiduciary obligation for anyone that is governed by them. Primarily, it starts with Nevada, and there may be other states that add to it. If we're going to wrap this up, because we got to get to a break here, but what's happening in the fiduciary space is troubling as to how it sets up to protect consumers. The rules that are being put in place don't protect them. And even the stuff that is being promoted and suggested as ways to protect them is limited in its effectiveness, because it's not really about protecting everybody. You have to be a CFP, you have to be in Nevada, and it's not really what will protect the majority of the consumers. So what we can go back to is, and I've said this before, is you should be asking your financial advisor to sign a fiduciary pledge saying that they will act as a fiduciary in all matters. They'll be fat. That they will act as a fiduciary at all times. If they're unwilling to sign that, and walk away. All right. So, horse is dead. I beat it. Let's take a break. When we come back, I'm going to cover long-term care insurance. This is a topic that's big, and a lot of people have questions about it. We're going to cover all of that when we come back from the break, and this has been Make It Last.
Hey folks, you know there are more than 500 different ways to claim your Social Security benefits, and most Americans will rely on their IRAs and 401ks to survive retirement. The pressure to make the right decisions at this stage of life can be enormous, as are the consequences for making a wrong decision. Victor Medina, host of Make It Last, is a certified financial planner that specializes in helping people in or nearing retirement, working with families that have been diligent savers and who value a trusted advisor. Victor is able to put together a customized total protection retirement plan that helps clients answer 4 important questions. Can you afford to retire? Are you overpaying your income taxes? Can your portfolio be improved? Can you eliminate or reduce threats to your retirement? It's never been more important to make sure your ducks are in a row, and it's never been harder to make your nest egg secure. The time to act is now. Call 609-476-9269 or email info@privateclientfamily.com to schedule your no-cost, no-obligation first meeting and get on the road to total protection.
Hey everybody, welcome back to Make It Last. We just spent that time talking about the DOL fiduciary role, and a lot of that news had come out in the paper, which is how I keep abreast of what's going out in the world. And another thing that had come up, which kind of triggered the reason to discuss long-term care insurance, is there was a report in New York Times about a woman who went from middle class to Medicaid. That's the way they titled it, middle class to Medicaid, and she had the better part of about $600,000 and spent it all in long-term care and then applied for Medicaid. And there's a whole article about that. And then it's kind of tying into the most recent healthcare reform bill, which looks to cut out Medicaid. And so it just got me thinking about long-term care insurance, because as we kind of try to put together the legal and the financial components of planning for getting older, they need to work together. One of the biggest benefits of an outfit like what I run, which has got the legal and financial, is that you're able to coordinate together those two areas so that they work the way they're supposed to. In any event, I want to spend some time on long-term care insurance, because this is a topic that comes up week after week after week. I'm meeting with people and we're reviewing their finances, and they're either approaching retirement or they're in retirement, and they'll say to me, Victor, should I have long-term care insurance? And almost the immediate reaction from me is, do you even qualify? Because many times by the time they're coming to see me, they may be so old that it's not really an option. And so I want to talk a little bit about what long-term care insurance is, why it exists, and then I want to give you some recommendations for what I think are kind of the best ways of addressing long-term care insurance, specific products. Because long-term care insurance, right? Insurance is in the name, which means by definition, there are 500 different products, and each one of them more complicated than the one before. And so really figuring out what you need can get difficult. People who spend their lives as insurance agents, and that's all they do, sell long-term care insurance like it's a single solution for a single person, and everybody should get the same thing over and over again. And what I've experienced in my practice has been that not everybody needs long-term care insurance. There are ways of combining legal and financial planning so that your long-term care concerns are covered, and that there are, in fact, some better products than others. Most of the time, they're not being sold as the frontline defense because they take more explanation to get right. And sometimes it's just easier to propose to somebody, something a little less expensive and just to get a signature on the line. So I want to talk about insurance generally, because you need to understand why the landscape of long-term care insurance has changed. When we think about insurance is traditionally been a way of transferring risk. So anytime you have risk, you have like a few things that you can do with it. You can assume the risk, you can avoid the risk and change your behavior, or you can transfer the risk. Okay, and transferring the risk is what insurance companies are all about. Now, in the theory of risk, you transfer risk when the likelihood of it occurring is low, but the economic impact of it is high. So let's illustrate this with property and casualty insurance, right? So in the property and casualty insurance, when you get homeowners insurance, the reason why you do that is that the chance that your house is going to burn down is low. It's not likely that you're going to have some form of a catastrophic event on your home requiring a claim. However, if you do need to file that claim, if something happens, the cost of that is really significant, right? What would it cost to rebuild your home? Most people don't have that in savings when it comes. And so they insure the risk by transferring it to an insurance company that pools together everyone's money because it knows it's not going to pay it out very frequently. But when it does pay it out, none of those members really has the ability to self-insure against the risk. Okay, long-term care insurance is about the same thing. What you're thinking about is that the likelihood that you're going to need long-term care is, if it's not low, right, it's at least indeterminable. We don't know really whether or not you're going to be the kind of person that needs long-term care. And in my seminars, when I talk about long-term care, I do mention that there's research out there about how likely it's going to be that you are going to need long-term care. And the research that I share is that 1 out of every 4 men, or 25% of men, will need long-term care sometimes in their lives. And 1 out of every 2 women, or 50% of the women, are going to need long-term care. And the men get happy in my seminars. They smile because they're less likely to need long-term care. And I stop them dead in their tracks. And I say, gentlemen, the reason why your incidence is so low is because 1, she was taking care of you, and 2, you're dead, which means that she needs help because she's got nobody to take care of her. So that's the reason why it is. But I have people focus not on the percentage chance that they're going to need long-term care, but thinking about the percentage difference between 0 and 100. Because either they will need long-term care or they won't. Either they're going to need to pay for consistent and persistent long-term care like home health care or an assisted living facility, or they won't. And so when they get that, when they're going to think about where they're going to put their chips, right? They're at a roulette table and the choice are black or red. They're either going to put their chances, all their chips on red, saying, I will never get sick, and then live with the consequence if they do. Or they say, we're going to plan for if we get sick and then live with the consequences if they don't, right? And so people trade these things off because the impact of needing long-term care is so significant. So significant. If you think about the cost of long-term care, home health care aides, they cost about $21 to $23 an hour with a minimum of a 3-hour stay. So that's $75 minimum on the day, and many times it's $200, $220 a day from just home-based care. When you look at an assisted living facility, the base level of that is about $5,500, at least in my area. So if we think about how much assisted living, and by the way, base, right? That's room, board, activities, the nice lobby, the shows they put on, and the free popcorn. That's $5,500. When you start to need more care, like you have a dementia condition and you need a lockdown unit, or like an adult daycare situation, when you need more care, that can rise to $8,500, $9,500, and then by the time you get to nursing home care, I don't know, $12,000 a month. So it's clear that it's super expensive. So insuring against that risk makes sense if you get the right kind of policy with the right kind of trade-offs, and you're able to shrink essentially what is your entrance fee to get into there. And I'll talk a little bit. I'm not talking about premiums, but I'm talking about the risk of never needing the policy. So when we get back, I'm going to go deep into the different kinds of policies that you have available to you, what it takes to qualify, and which ones we recommend, so that way you can examine long-term care insurance on your own and think about long-term care planning, not just within the context of legal planning, but also legal and financial, and putting it together as one package. Stay tuned. We'll be back right after this break talking about long-term care insurance. Thanks.
Hey, it's Bert. I hear a lot from people that the one asset they're most interested in protecting from the devastating cost of assisted living or nursing homes is their own home. The team at Medina Law Group can meet with you to discuss options to help protect that home, including their special Home Sweet Home Trust. It's designed specifically to protect the value of your home in the event that you need long-term care in the future. Just call the experienced elder law attorneys at Medina Law Group at 609-818-0068 to learn more, including your chance to schedule a free consultation. You can also visit MedinaLawGroup.com to learn more about protecting your assets and the Medina Law Group team. For peace of mind and a solid foundation, call Medina Law Group at 609-818-0068 or visit MedinaLawGroup.com.
Well, welcome back, everybody. Thanks for staying with us. We've been talking about long-term care insurance, and we're finally going to get to the meat of the show today and talking about what kinds of policies are available and what you should consider when you think about long-term care insurance. Now, long-term care insurance basically comes in two different flavors. You can get a premium-based policy, or you can get an asset or a cash-based policy. Now, most of the people who have long-term care insurance have a premium-based policy. And the way that works is that you pay a premium to the insurance company, but just like term insurance, if you stop paying that premium, you have no coverage. Okay? And so that premium continues essentially indefinitely. And they're allowed to raise the premium rates based on your participation in a group. So we might say every male who's age 78 to 80, we're going to increase premiums by 17%. And so you do that across the board. The other thing about a premium-based policy is that like a term life insurance, there's no cash value. So what you pay into it is the pure cost of insurance. No other way to say it. Like you're giving money to the insurance company, and it's just a straight transaction. There's nothing you're getting back out of it. If you don't need long-term care anytime in the future, you get nothing back from that policy. You just paid it. There's a risk involved with that, a financial risk, because as you get older, the likelihood of you getting sick increases, right? So the chances that you're going to need long-term care when you're 50 and you take out that policy, they're super low. And so premiums, they just reflect the risk. But as you get older and you get a little bit more frail, and the numbers that the insurance company are running suggest that you might get sick in the future, well, at that point in time, risk goes up, and so the premium goes up. Now, the risk that I'm talking about is a financial risk, because in retirement, most people are on fixed incomes. They're taking Social Security and a pension, and they're not really getting increases on that match the increases that the insurance company is trying to charge on it. So what happens? You get older, and it gets more expensive. It takes a bigger portion of your fixed income on a monthly basis, and you decide to drop it when you most need it. And I can't really fault somebody for that, because they're making some very hard choices about, do I have enough money for dental insurance or for long-term care insurance, or to get a new car or to keep my long-term care insurance? I mean, every month or quarter, there's a decision about whether or not to keep this policy. Now, that's a premium-based policy. On the other side, what we recommend, and we find it to be most effective when we need it, is an asset-based policy. Now, an asset-based policy is essentially one in which you are contributing money that has cash value. And so the policy is one that exists where if you need long-term care insurance, it has a benefit that it will provide. But if you never need long-term care insurance, there's also a benefit there. So you might think about it like a life insurance policy where you're contributing this money, and if you use long-term care, there's a big benefit, right? They've increased whatever they're going to be giving you, and you have some leverage on your money. Put $200,000 in, might get $400,000 worth of long-term care. But if you never use the policy and you die, there's a death benefit. And in that death benefit, you pass that money off to your kids. So the way to think about it is that money is not lost per se. Okay. And that's in the form of an asset-based care. Now, there are other forms of asset-based care where there's no death benefit, but where the premiums are set, that you are fully paid into the policy, so that no matter what happens in the future, you get older, your risk increases, you have a fully paid policy, and they can't increase the premiums. And in fact, you don't have to really worry about the premiums because you've prepaid all of them. All right. Now, this is a trade-off. These kinds of policies are a trade-off, because you are trading off your ability to make money on your own money, right? You're going to carve out a portion of your portfolio. You're trading that, and you're giving it to the insurance company. And the insurance company is making a deal with you that says, if you get sick, we will give you more money than you could possibly have created in this time, but for long-term care. And if you don't get sick, we'll give you a little bit of a return on your investment, but we're going to keep the bulk of what we were able to generate in terms of, growth for that portfolio. That's the trade, and the trade is a transfer of that risk over, and you're giving up the ability to make that money. Now, many of my clients make the decision to give up that because they want to insure in the risk. And if you think about, someone's portfolio, you got $1 million in there. It's unlikely that you're going to spend all $1 million, but if you carve out $200,000 or $250,000 of that and contribute it to a long-term care policy, the nice thing about that policy is that if, in fact, you want to cancel it, let's say that 20 years from now, the government covers everyone's long-term care 100% and long-term care insurance is no longer necessary. Free healthcare for everybody, including long-term care. Well, we can go back to the insurance company and say, give me that money back. And so at the end of the portfolio, when we're starting to run out of money and we say, geez, it'd be nice if we had that $250,000 that we gave the insurance company, they'll give it back to us. Now, we would have lost any money that we could have made on that. That's fine. I understand. But it's not a lost investment. The way the premium-based is, where all of the money that you're contributing is essentially gone. And some of these policies that are the asset-based kind, the ones that we recommend, they can be with 100% of a return of premium, an 80% return of what you've contributed. And they can configure them all kinds of ways. But, my experience has been that this is great peace of mind for my clients because they're able to ensure that they have a fully paid long-term care insurance policy that won't increase in premiums, that can never default or go out of effectiveness, and basically cover that need in the future. Now, look, long-term care insurance is not a panacea for covering long-term care. It might cover a lot of it. But what we've experienced over the history of having these kinds of policies and the increases in the cost of care is that the cost of care increases faster than the value of these policies. Whatever you're pegging it to today is unlikely to be that number in the future, and it's hard to really grow it that quickly because long-term care insurance has grown, faster than any investment I know. The cost of long-term care has increased, I don't know, 11% annually. There's an investment in the world that guarantees that. So, if we're having a 5% increase on an inflation rider or a 3% compounding in the way some of our policies do, that's helpful that it will, at least try to keep pace. But it's unlikely that it's going to keep pace 100%. But I look at long-term care insurance as essentially that way of easing how much of your own money that you're using, or at least leveraging it. You turn your money into 1 or 2 times what it was going in, and that just stretches it out. Now, this needs to be combined with legal planning, because legal planning will be able to secure assets that your long-term care insurance, it's going to have some finite value. It will run out at some point in time, and so we don't want to be in a position where we threaten the home or other investments because we've run out of long-term care insurance and you've just gotten too sick for too long, So those are the ideas behind long-term care. And if we think about long-term care insurance and we think about how to cover for it, the plan really needs to be holistic. It needs to cover legal solutions and financial solutions, and they need to be working together. And you need to know which monies are going to be there to protect your IRA versus your brokerage account, which is a big, long pitch for you need to be working with an advisor for this stuff. And it needs to be somebody who's holistic enough to understand legal and financial planning, be able to provide insurance, be able to provide investment, be able to cover all of those things. And going back to the first segment, folks, be a fiduciary and put your interest first and not be a product salesperson in what they're doing. So that's long-term care insurance. That's really what I wanted to cover for today. And I know there are other areas that may come up from time to time, and I might address them, specifics on different kinds of policies or situations or how it works with Medicaid. We haven't covered everything, but we've given you an introduction, at least today, on what long-term care insurance looks like and why you should be thinking about that as part of your overall planning. All right. So that's it for today. I want to thank everybody for joining us here. I want to thank the production crew for making us sound so good. And in fact, if you love this show, please go on to iTunes and rate it highly so that other people will find it if they do a search for great retirement planning podcasts. And then if you have a friend that might benefit from this, go ahead and send them the link. Tell them, look at this up. It's 30 minutes a week, and it's something that's going to help you learn more about all of these topics. And I think you should listen to it, and that'd be a great way of sharing it. Anyway, we're going to catch you again next Saturday on Make It Last. And I want to thank you for joining us today. And this has been Make It Last, where we keep your legal ducks in a row and your financial nest egg secure. Catch you next Saturday.
The foregoing content reflects the opinions of Medina Law Group, LLC, and Private Client Capital Group, LLC, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal strategy. There is no guarantee that the strategies, statements, opinions, or forecasts provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses, which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs.